Okay, so welcome back. This is our weekly market insight, and here we're going to cover the macro outlook. So, where do we start? So, central banks, I guess. So, it was a bit of a mixture, but central banks sort of, rates are at or very near their peak. And I think now that investors are beginning to understand, that these central banks really mean business and this higher for longer is going to take us well into next year. If we look at when the rate cuts are going to come, because after all of this settles down, then that's what we're all going to be looking for. Then personally, I expect the ECB to probably be the first out of the three that I focus on the most. And that could even be in Q2 of next year. Then I think the Bank of England and the Fed, any rate cuts from them are going to be in the second half of the year. But the Fed's probably next December, if I'm honest, because that used to be their traditional time for changing policy. So when I say cut rates, what I really mean is potentially a 25 basis point cut. It's not going to be anything drastic. It's not going to be big. And any cuts are going to be measured because they need to prevent inflation rising again. They've got to keep that demand under control and balance that with the available supply. That 2% target rate will still take some time to achieve. And of course, the closer you get to it, the more difficult it becomes as well. So, I think for them, why some of the pauses have been, those decisions have been taken is because all these previous hikes that they've done have still not fully sort of entered the economy yet. That's still filtering through. Now, for me, I still believe that the US are likely to manage that soft landing. However, there's a few hurdles sort of creeping in there in front of them at the moment, I would say, and they need to jump them. So first one is these auto workers striking, and of course that could add another boost because you're going to get higher wage demands, not just from them, if they're successful in other companies as well, other workers, similar problems, and that could push up car prices as well. Immediately, because if there's a shortage, that's going to push up the value of cars that are there, or even second-hand cars. And if the strike continues, and then sort of longer term, car prices may rise, new car prices may rise to cover those wage settlements. Now, as I mentioned in the earlier part, the government could be forced into a shutdown. This is just due to political posturing between the parties. For me, this is embarrassing. Okay, I'm not US, I'm not American, so I'm looking at this from an economic perspective. And I just think it's embarrassing for the number one economy. It's time that they sat down and they came out with a formula to prevent this becoming such a political debate and posturing. It's to be honest, it's pathetic. But of course, and again, it's going to create risks to jobs. And their behaviour, it's just unfitting for the world's number one economy. But most politicians are like kids, I suppose. Right, so Powell was very polished. He was very careful in his remarks at the press conference that followed the rate decision. And of course, that dot plot does leave the door open for one more hike if inflation refuses to drop further. He expects PCE out that's coming out this week by the end of this year to be 3.3% and not to hit 2% until possibly 2026. He has increased his GDP expectations for this year though to 2.1%. And he expects 1.5% growth in 2024. He also expects employment to slowly rise to probably about 4.1% in 2025. Now, again, the rate decision was for the Fed was split 7-12. So again, it only would have taken 3 votes again, you know, and to hike to change that around, but they got that through. So a pause seems the most sensible thing to do at the moment. Just hold back that additional rate hike in case they need it at a later date. Shelter, so rent, housing and all that seems to have started to drop in the US. Plus gas prices, they fell, especially after the strike by the LNG workers in Australia was settled. A concern though is WTI prices. They're steady, you know, around about $90 on average for most of last week. And it does give that steady undertone, which is going to push gasoline prices higher and hold them there as well. So, I mean, oil's up 15% in the past month. So Treasury yields hit a 16-year high. And of course, that, amongst other things, led to stocks having a really bad week. You know, for me, I still think that more and more investors are going to reduce their stock portfolios to increase their bond holdings. You know, you've got that guaranteed rate, and of course, stocks have had such a great rally that, you know, maybe it is time to take some of those profits and lock in that fixed rate, because, you know, if you buy treasuries, you've got that fixed rate all the way through the term. That's why they're called fixed income. You know, got a fixed rate and a fixed length of term before they mature. On company news, Microsoft should finally gain approval to purchase Activision after the UK seems happier with their solution to getting that passed. Amazon plan to include ads onto Prime Video early next year, although of course subscribers will be able to pay $2-3 a month to stop them. Global debt is now $307 trillion. And again, you know, sort of debt levels, I think, are something that you need to start watching in the future as our sort of focus comes more off of inflation. Then, you know, when we look at sort of government debt, consumer debt, corporation debt and all that, it's really been ballooning. And of course, you know, a lot of these loans that are out there, that fixed period is starting to come off any time from now into the next year or so. And that refinancing is going to cost people, companies, governments more than double with their interest payments. If we look at the EU, although we're short on data last week, the PMIs show that you know, the economies are continuing to contract. Although Germany's did improve slightly. On the other side of that, France's were weaker. I still come back to this sort of temperature situation, this weather. So I guess unless it is a severe winter in Europe, they could get away with like perhaps a shallow recession. I just can't see them avoiding a recession at the moment. And in the UK, the Bank of England kept rates unchanged. Inflation is still way too high, but it was surprised and is dropping faster than expected. But again, is that rates? For me, it's prices themselves. You know, consumers are being more cautious with their spending. A recession is becoming more likely in the UK, though. And you're going to sort of start to again notice that unemployment increases probably at a faster pace. You know, I warned ages ago that you're going to see less jobs on offer and you're going to start to see the jobless increasing, and you know, that's playing out. You know, it's just obvious. It wasn't anything special. It was just obvious that had to be the case. So energy prices remain unpredictable in the obviously with oil so high, although gas prices are continuing to drop, which is good news for Europe. Indeed, household energy prices are dropping for the consumer as well. This week my supplier expects lower prices, and he also warned that they're going to cut my prices by about 8%. So You know, happy days. Of course, let's see what the temperatures do over winter, because again, that I think that Europe's probably got very good gas reserves at the moment. So, you know, if it's not too severe, then I think that they will get through that okay. If the weather's really dropped down and they're as extreme in the cold as they were in the summer with the heat, that could be a different picture. Now, in Japan, Ueda sort of backtracked a little bit and poured cold water on any expectation for them to move rates into positive territory yet. And of course, that sort of put pressure on the yen. So the Bank of Japan left rates unchanged at negative 0.1%. The Swedes hiked to 4%. The Swiss surprised with a pause. Most have expected another hike there. So when we look at what's going on geopolitically, support for Ukraine in some areas, you know, after 19 months just seems to be weakening a little bit from some countries. And, you know, even potentially in the US with the Republicans, looking, you know, at sort of budget cuts and looking at all this overseas support that they're giving. And of course, Poland is on the other side of that. You know, for them, it's about the grains rather than the weapons. And again, you know, because Russia pulled out of the agreement which allowed Ukraine to export, you know, which eventually made sense, I suppose, and then they obviously started bombing the ports to try and prevent them from exporting. So Ukraine's been trying to sort of push their grains out to their neighbouring countries, and of course, neighbouring countries don't want that, because then that sort of really drives down the price because supply is so high, and it's no good for their local farmers. So that's become a little bit of a tension area there. And of course, while we're on that subject, the EU could actually expand its membership by 2030 as it considers Ukraine's application and also Moldova. China data has shown signs of improvement, and now they're considering relaxing rules capping foreign ownership in domestic companies. That's listed traded companies. Now, you know, when we're looking at things, fossil fuels sort of, let's be honest, they remain hard to replace. You know, solar power is becoming a more popular solution, I would say. Of course, countries want to get down to this zero emissions, but, you know, there's such a price to be paid for that. And of course, you know, when you look at solar power, most of those panels are made in, yes, you've guessed it, China. So, you know, just mentioned, I think that most of the countries, everyone wants to stop global warming, everybody wants zero emissions, but the cost of that is phenomenal. I mean, you're talking trillions to hundreds of trillions across the globe to make that actually happen, to become carbon neutral. And of course, a big problem is just that lack of supply of alternatives. And that, you know, that for me, that cost of change, that cost of that zero emissions is really going to keep fossil fuels popular and a preferred choice for many years to come, despite all these targets. You know, I just expect these targets to get kicked down the road. I'm sure, you know, if you look back over the last 20, 30 years, there's been a lot of times we've had all these meetings and commitments with governments to cut all these emissions, but to be honest, not much has really happened. And of course, talk is cheap. Action in this case is very much more expensive. Okay, so we've got lots of data this week, especially from the US, which includes PCE. Again, you know, just highlighting that because it is the Fed's preferred indicator for inflation, and expects plenty of central bank speakers as they discuss why they did what they did last week. Okay, so that's the end of my macro outlook, and in part 4 I cover a lot of analysis. Again, you know, all we do is just try and help you prepare for the week ahead, understand what's going on in the world, just to help you make those more informed decisions. So we offer newsletters, we offer workshops, 1 week courses, our comprehensive masterclass that's really going to help you. You know, apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So, you know, that's you know, I'm not saying I'm going to turn you into a massive trader in 20 sessions, but you know, getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. You know, maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.